Okay. So we're now ready for the conclusion of our Chapter 5 video lecture. We left off trying to determine how to calculate our cost of goods sold under the LIFO cost flow method. Now remember that under LIFO, you assume whatever you purchased last was sold first under the LIFO cost flow assumption. So here's our graphic showing our actual purchases. And we sold a total of 43 bikes. So on the LIFO, we sold these 25 first from August 21st. And then we sold 18 of these 20 that we purchased on March 18th. Because LIFO says or assumes whatever we purchased last was actually sold first. Therefore, under LIFO, your cost of goods sold is $10,210. Now, to compute your ending inventory, you'll subtract cost of goods sold from cost of goods available for sale, and the difference would be your ending inventory. So this is the cost of those 12 bikes remaining at the end of the year under the LIFO cost flow assumption. Now remember that cost of goods sold plus any inventory added together must always equal your cost of goods available for sale. Okay? So now we got one more to do. We're going to do these same calculations, but this time on the weighted average approach. With the weighted average approach, you're going to determine what is the average what's the average cost per unit. Again, what is the average cost per unit? So, our total cost was $12,650 for a total of 55 bikes. So do me a favor, please. Take 12,650, divide that by 55 to determine what's going to be your average cost per bike. So the 12,650 divided by 55 gives us an average cost of $230 per bike. Now we sold 43 bikes, right? So multiply the average cost times the quantity sold. So your cost of goods sold with the weighted average approach will equal $9,890. For ending inventory, we still have 12 bikes remaining. So take those 12 times the average cost. Your ending inventory value is $2,760. Now remember, your cost of goods sold plus ending inventory under all these methods, we add those two together, they still must equal your cost of goods available for sale. So now, ladies and gentlemen, let's take a look at all three methods and the results they'll have on our financial statements. I'll begin with the statement of cash flow. If you choose FIFO, LIFO, weighted average, it does not change the statement of cash flow. This still shows the cash coming in and the cash that we pay for the actual inventory. But it will impact your balance sheet and your income statement. Now, our sales stay the same under all three approaches, but your cost of goods sold is going to be different. Notice that under FIFO, it gives us a higher gross margin, LIFO a lower gross margin, and the weighted average will always be in between. Okay? So what we're saying here is that depending upon the company and what they're trying to do, if I'm trying to attract more investors, I'm going to choose FIFO because that shows me a higher gross margin. But listen carefully, if I'm trying to pay less in taxes, I'm going to choose LIFO because that gives me a lower gross margin, which means I'll pay less in taxes to Uncle Sam. Uh-huh. Accounting is about strategies, thinking about what is the best method to use to meet the goals of your business. Now, all three are legal. Therefore, I can choose from FIFO, LIFO, or weighted average and compute my cost of goods sold. Now, it also has an impact on the balance sheet. On the balance sheet, an inventory has a higher value under FIFO, a lower value on the LIFO, and somewhere in between with the weighted average approach. Okay? Now, so we said that FIFO produces the highest gross margin, which also produces the highest net income and the highest income tax. LIFO gives us the lowest gross margin, the lower net income, and the lower income tax expense. So each method will have its own perceived benefits. Okay? Now, we focus on the income statement, which is financial reporting. What I do want to tell you is that the income statement is based upon the accounting principles that's called GAAP. Your taxes are based upon the IRS code. In some instances, companies may use one approach for financial reporting, income statement, and a different method to compute their income taxes. Okay? But the tax return must explain any differences. So if I use FIFO on my income statement, but LIFO on my tax return, I have to reconcile the difference between what was on my income statement compared to my tax return. However, this is the law. If the company uses LIFO, and again, LIFO will give you a lower taxable income in terms of inflation, the Internal Revenue Service requires that companies using LIFO for income tax purposes must also use it on financial reporting. Again, the IRS requires that companies that use LIFO for income tax purposes must also use LIFO for financial reporting. Okay? So these illustrations assume an inflationary period, meaning that as time goes on, prices are actually going to be rising. Now, if by chance there was deflationary, meaning prices were going down, then the impact of the LIFO and FIFO would have been reversed. In terms of deflationary, then LIFO would have gave you a higher gross margin, and FIFO would have been the one that would have caused you to pay FIFO to get a lower gross margin in terms of a deflationary period. Okay? So LIFO produces tax advantages in inflationary periods while FIFO will do the same in a deflationary environment. So a lot of companies use LIFO because it does reduce their taxable income, and once again, that allows them to pay a lesser amount in income taxes. Okay? Last thing we have is our full disclosure principle. The accounting principle known as GAAP allow each company to choose the inventory cost flow method that's best suited to its reporting needs. Okay? However, you must disclose the method that was chosen as part of your annual result. So if a company uses FIFO, you must indicate that in the annual report. If you're using FIFO, etc., you must disclose the accounting approach you're using as part of that company's annual report. In addition, financial statements are comparable from year to year. The GAAP principle requires you to be consistent, meaning that you can't use FIFO this year, LIFO the next year, average cost 2 years later. No, you have to be consistent. If you're using FIFO, continue using FIFO. Same would be true for the LIFO call flow approach. Now, if you do switch from one to the other, you must give an explanation as to why you switch accounting records and show the impact it has on your financials from switching from one accounting period over to the next. Well, I hope you have enjoyed this lecture on chapter 5, covering receivables and inventory. Until next time, see you later. Bye bye.